go through the book 0 to 1. Actually, one of the best chapters in the book. Peter Thiel, guys, he's a billionaire. So if you don't want to take my advice, take it from Peter. We're going to go through this podcast, Founders Podcast, amazing podcast. Let's get it.
And he's famous for. I'm just going to read it to you and explain it to you. In this context, it's somewhat interesting. I think it's more interesting when he applies it to what is the contrarian question for businesses. In other words, what is the most valuable business no one is building at this moment? Whenever I interview someone for a job, I like to ask the question, what important truth do very few people agree with you on? The question sounds easy because it's straightforward. Actually, it's very hard to answer. It's intellectually difficult because the knowledge that everyone is taught in school
We're back, baby.
Definition agreed upon. And it is psychologically difficult because anyone trying to answer must say something that she knows to be unpopular. This is a fantastic line here. Brilliant thinking is rare, but courage is an even shorter supply than genius. So the contrarian question is, what important truth do very few people...
This is an amazing question to ask.
To give an example of a way to answer it.
When I was doing my podcast for SAS Mining, I would always end on this question. And I actually would give the guests a heads up that I was asking this question, because there were times where I sprung this question on them. And it's just such a difficult question that, you don't want to put them in an uncomfortable spot. Because if you think about it, and he explains it here, but what is one thing that the majority of people would disagree with you on? Then it's almost like a multi-part question, because you need to know the thing that the majority of people believe, and then you have to have a contrarian opinion. And Peter Thiel relates this to startups and what is it that makes an amazing startup? It's like, well, you almost have a conspiracy. You've got this contrarian belief. You've got this hidden secret about the world that is going to allow you to build an amazing big company. And, I think that he'll dive into it a little bit later in the video, but it is something to reflect on. What if you really just ask yourself honestly to answer that question? What's coming to mind? Also, if you get this question in an interview later in the video, they're going to tell you exactly how to answer it. So stay tuned.
A good answer takes the following form. Most people believe in X, but the truth is the opposite of X. Why they start this book out?
There you go.
Most answers to the contrarian question are different ways of seeing the present. Good answers are as close as we can come to looking into the future. The subtitle of the book, How to Build the Future. So that is why he starts the book with the contrarian question. It's to prompt you into thinking, seeing the present in a different way. That's how it relates to How to Build the Future. The other part of the subtitle is Notes on Startups. Why did he connect the two? Because he feels startups are the ones that are actually are the only ones capable of actually building the future. This is why. New technology tends to come from new ventures. Startups.
Next Level Gamers, what's up, bro?
And this next sentence ties both parts of the subtitle, Notes on Startups and How to Build the Future, together. Positively defined, a startup is the largest group of people you can convince of a plan to build a different future. A new company's most important strength is new thinking. Even more important than nimbleness, small size affords space to think. This book is about the questions you must ask and answer.
So guys, one of the things that you guys have noticed, we're in a new setup. We're figuring it out. We have our automatic gimbal here. So that's a great question, Next Level Gamers. I was nerding out yesterday, back for Thanksgiving, showing the fam all of the new gear we got. But yeah, this thing's really cool because it'll follow me anywhere. And so you guys are going to see I'm on my phone doing some work for my worker, my assistant. She's going in to, still going in today, and we're hopping on a Zoom or a Google Meet in 50 minutes to work remotely. But I'm going to leave this playing. And yeah, feel free to toss any questions in the chat. Great question, Next Level Gamers. I actually just went and learned all of this on my own. Like all of this stuff. Not too long ago, I hadn't even like watched a stream before, but I just kind of like anything when you're building a company, you just dive in and you're like, okay, I'll figure it out. So I went, learned about all this stuff, and yeah, just kind of set it up. By the way, the equipment that is actually here is the Osmo P7 by DJI. So DJI Osmo P7 Mobile. It's like a little gimbal with a face tracker. So it'll follow me wherever I go. Yeah, keep playing for you.
To succeed in the business of doing new things. What follows is not a manual or a record of knowledge, but an exercise in thinking. That's fantastic, because that is what a startup has to do. Question received ideas and rethink business from scratch. So then Peter spends a chapter talking about what it was like building PayPal during this kind of massive scale.
I think now is a good time to get into AI.
Actually became friends with the author. His name's Jimmy Soni. I covered it back on episode 233. It's called The Founders, the story of PayPal and the entrepreneurs who shaped Silicon Valley. It covers the 4-year history of PayPal. In fact, Jimmy spent more years researching that book. He spent 5 years researching, writing that book. So he spent a year longer than actually PayPal existed before it was sold to eBay. But there's a ton of useful information in that book. If you haven't listened to the podcast, listen to it, but then buy the book, because there's just a lot of useful ideas for startup founders in there. But Peter, in this book, and the one I'm holding in my hand now, is talking about 1999 was a really crazy part. And he starts out saying, this quote from Nietzsche, he says, "Madness is rare in individuals, but in groups, parties, nations, and ages, it is the rule." If you can, why is that important to startup founders? If you can identify a delusional popular belief, you can find what lies hidden behind it. The contrarian truth. Why is that important? He just told us in the last chapter that success is finding value in unexpected places. That value usually goes against the conventional thinking or the conventional beliefs of the time that you're operating. And the weird thing is it's hard to tell while it's happening. He says conventional beliefs only ever come to appear arbitrary and wrong in retrospect. Whenever one collapses, so whenever a conventional belief collapses, we call the old belief a bubble. And so he was building PayPal during the first dot-com bubble from September 1998 to March 2000, and that's what he's going to talk about. And really, I don't know why. So he's describing like the crazy behavior that was taking place in Silicon Valley during this time. And I'm just going to read my note to you first, because I don't know why it popped in my mind, other than I guess he's describing things that have nothing to do with serving the customer. So I realized to myself, I was like, oh, an antidote to irrational mania, right? Which is, he's just quoting Nietzsche. He said, madness is rare in individuals, but in groups, parties, nations, and ages, it's the rule, right? So we're prone to it. I'm prone to it. You're probably prone to it. We're just humans. We're prone to this. It's like, what is the antidote to irrational mania? And it's asking yourself, how does this behavior that I'm doing for my company actually help the customer? None of the stuff that's going on in this chapter was helping the customer. And so way to anchor yourself around, how is this helping my customer? It's really a way to act sane when everybody else is being crazy. So he says, when I was running PayPal in late 1999, I was scared out of my wits. Not because I didn't believe in our company, but because it seemed like everyone else in the valley was ready to believe anything at all. Everywhere I looked, people were starting and flipping companies with alarming casualness. And I love the fact that he used the word alarming casualness. One of my favorite
alarming
things
casualness.
John D. Rockefeller ever said. I read his autobiography, which he wrote as a much older man. I think he was like maybe 80 years old when he's writing it. It's episode 148. If you haven't listened to that, if you haven't read the book yet, you should read it because you read it in the weekend. But the podcast I also think is really good. But I love the way where Rockefeller lets his ego slip when he's writing the book, because he's talking about
so cool.
He was working for these two partners. This is before he started his own company, and he just thought they were really sloppy. And he says their casual way of conducting affairs.
All right, I'll give it a little pause, answer the questions in the chat. So someone was asking how big the team is, right? So to give you the background, I'm working on a couple of different things right now. First one is a Bitcoin mining company. I started back in January of 2018. So it's been a little while. We've been building it. Fast forward, I mean, maybe I should do this, like an episode sometime, give a full breakdown of like kind of the journey. But fast forward all these years since 2018. Today, the company has grown quite a bit. We're operating with Bitcoin mining facilities, like data centers, on 4 different continents. So we're in the US, we're in Paraguay, we're in Ethiopia, we're in Norway, and mining a bunch of Bitcoin, fully on renewable energy. If I was to actually answer the question that Peter Thiel asked earlier or that was covered in this video, which is what's one thing you believe to be true that the majority of people would disagree with you on, where my mind goes instantly is related to things that I learned when building that company. And in particular, it's actually around Bitcoin mining and energy, just because I spent so much time learning about how all of this stuff works. I haven't talked too much about it on stream, but yeah, I guess that's a whole separate discussion. But to answer your question, how big is the team overall? SAS Mining, I believe, is 14 full-time. And then there's a ton of people that work not full-time, but you could think of that as like the core generals that like operate like big sections of the business. And then outside of SAS Mining, right now I'm building My Worker AI. And so this is, if you want to look at a company, like in reality, I think this is a good analogy where it's like a kid that grows up, right? And so in the early days, like you really need to take care of the kid to make sure that it survives. You know, it's like a baby. You need to get it there. And so My Worker's still in that stage. It's still very early. We've got a lean team. We've got a lot of growth potential, a big market. And right now, that's taken up the majority of my time. Like in those early days as a founder, you're just like grinding to get stuff to work. And so the team at My Worker right now, it's myself and a number of people that are working on the tech side, not full-time, more like part-time. And then my assistant, and then we've got a team of 3 out in Bolivia on the marketing, clipping, distribution side. I think that just talking about like my thought process on this, and then I'll let the video continue playing. I think that right now with what we're doing, it's like David versus Goliath, right? It's like you're the underdog. You have these existing incumbent sales companies that, although their products are kind of like dinosaurs, they've got amazing systems, distribution, like fulfillment, enterprise teams. Like you're talking about some of the largest companies out there in tech. And so we're going and we're saying, hey, now with AI, you can do things in a much better way. You can do it in a different way. And we're trying to build this new product while acquiring customers. While there's just a lot to do. And so with where we're at the moment, I thought, we need customers. We need to continue improving the product. We need investor capital. And then we need to build systems internally. And finally, my view is that distribution is going to become so much more important. And, I don't know how you guys operate, or I feel like everyone's a little different, but at least the way I am, I think that you get really good at like one thing at a time. Like you can do multiple things, but there's got to be something that you're always improving on, and if you put hyper focus into it, you can get really good really quickly. So like what you mentioned, Next Level Gamers, around how did I learn all this stuff? Well, right now, the initial part of my focus where I was like, we're going to ideally level multiple areas up, but the one area where you're leveling up is we're going to understand how all this stuff works, because I think that distribution's so key. And I do think that having the ability to consistently, share what you're doing and then ideally help other people along the way with that content is going to become more and more important over time. It's like witchcraft. I think I mentioned this the other day, but when I say witchcraft, it's like you are duplicating yourself. It's like you wish when you're building a company that you had another one of you, 2 other teammates, 3 other teammates. You wish you had a bigger team. When you do something like this, it's like multiplying me into multiple different areas. And so I think that that was one of the things that made me think, okay, well, I can go and try and raise investor capital. I can go and try and focus on customers. I can go and try and focus on all these things. But simultaneously, I do need to figure this thing out because it is going to be important if we want to have a chance to compete against these behemoths of companies. So anyway, long ramble, answer your question. I'll leave it plain. And once again, guys, if you're just joining, I am also going to be looking down at my phone quite a bit just because I got to prep for when my assistant gets into the office.
Did not appeal to me. And you get the sense in his writing that he was disgusted by their sloppiness, and then he never states this, but I kind of read through the lines, it's like, oh, no wonder these guys wind up going bankrupt. They deserve to be bankrupt. They were scrubs. But all these ideas are just embedded in this line of being disgusted by their casual way of conducting, essentially their casual way that they approach their business. And even, I think it was like 16, maybe 17, I forgot how old he was when he was working there, maybe 18. But even that, he's just saying that just this casual way of conducting affairs just did not appeal to me. And so we see that same terminology here. Everywhere I look, people were starting and flipping companies with alarming casualness. And Peter continues, acting sanely began to seem eccentric. And so he's describing this environment, and then he describes when it pops. And he says on February 16, 2000, the Wall Street Journal ran a story lauding our viral growth and suggesting that PayPal was worth $500 million. And I think for experienced founders and investors, this next sentence, that you've seen the behavior like this in the past, for other people, they think, oh no, the world can't possibly work this way. And it does. And this is going to remind me of my favorite quote, one of my favorite quotes, I should say my favorite quote, from Naval Ravikant. And he says, my number one repeated learning in life, there are no adults. Everyone is making it up as they go along. Figure it out for yourself and do it. Why is this tied to what Peter's talking about in the book? Because he's like, well, this Wall Street Journal comes out on February 6th, this article on my company, PayPal, comes out February 16, 2000, says, look how fast these guys are growing. It suggests that PayPal was worth $500 million, right? The journalist writing that just took a number out of thin air. Well, why does that matter, right? Because this very next sentence will blow your mind. When we raised $100 million the next month, our lead investor took the journal's back of the envelope valuation as authoritative.
This is fucking crazy.
Other investors, I mean, we're kind of going through a period a little bit very similar to this. At least that's the opinion of this legendary investor named Bill Gurley. He was in this industry, working in the industry. I saw him reply back to somebody. Somebody asked, for people who were there, does this feel, meaning the time that we're in right now, does this feel like the dot-com bust level unwinding yet? And his simple answer was yes. And so Peter's going to describe more what was taking place at this time. Other investors were in even more of a hurry. A South Korean firm wired us $5 million without first negotiating a deal or signing any documents. When I tried to return the money, they wouldn't even tell me where to send it. And so Peter says this time was crazy, but the problem is the people that live
fucking crazy
actually learn incorrect lessons. So there's going to be, essentially has four opposite principles for entrepreneurs. First, he's going to describe what is the normal reaction to the dot-com bust, and then his reaction, which is almost completely opposite. He says the entrepreneurs who stuck with Silicon Valley learned four big lessons from the dot-com crash and are still guiding business thinking today. So I'm going to tell you just one or two sentences from the description because this goes on for a page. I'm going to read the whole thing. It's actually 2 pages, but number one, make incremental advances. Small incremental steps are the only safe path forward. So he's describing what he feels is a conventional lesson taken from the dot-com bust, and then he's going to describe the opposite, what the lessons he took that are almost completely opposite. So that's number one, make incremental advances. Number two, stay lean and flexible. All companies must be lean, which is code for unplanned. Planning is arrogant and inflexible. Number three, improve on the competition. Do not try to create a new market prematurely. Number four, focus on product, not sales. Technology is primarily about product development, not distribution. So one of my favorite things in the book is the fact that he repeats that over and over again, that sales and distribution are just as important as product. And so he says, these are the four things that most entrepreneurs learn from the dot-com crash. This is, he's saying, well, actually the opposite principles are probably more correct. And so this is Peter's four opposite principles for entrepreneurs. Number one, it is better to risk boldness than triviality. Number two, a bad plan is better than no plan. Number three, competitive markets destroy profits. Main theme of the book, do not build an undifferentiated commodity business. He does a great job of describing in this book how power laws rule everything around us. I'll get there in a second, but that's what he's talking about there. Competitive markets destroy profits. Number four, sales matters just as much as product. And then again, he explicitly tells us why he's writing this. To build the next generation of companies, we must abandon the dogmas created after the crash. That doesn't mean that opposite ideas are automatically true. You can't escape the madness of crowds by dogmatically rejecting them. Instead, this is my favorite part of the contrarian question. Instead, ask yourself, how much of what you know about business is shaped by mistaken reactions to past mistakes? The most contrarian thing of all is not to oppose the crowd, but to think for yourself. That is a main theme that you and I have talked about over and over again. None of this works for entrepreneurs and investors if you cannot trust your own judgment. If you cannot trust your own judgment, you have to go work for somebody else. The business version, now we get to the part that I was referencing earlier that I said is my favorite part about the contrarian question. The business version of our contrarian question is, what valuable company is nobody building? This question is harder than it looks because your company could create a lot of value without becoming valuable itself. Creating value is not enough. You also need to capture some of the value you create. And so now we get to one of his main themes is that you should aim for monopoly. But he says, by monopoly, we mean the kind of company that's so good at what it does that no other firm can offer a close substitute. So he started the chapter on the previous page comparing the market cap and profit performance of all the airlines compared with Google. So there's only one Google, therefore it can capture a lot more of the value that it creates, where all the airlines, the planes may look different, but they kind of do the same thing. They all do the same thing. They're just transporting you from point A to point B. And so his point is that you want to avoid competition. The way you avoid competition is by aiming for monopoly. And this is one of the punchlines. The airlines compete with each other, but Google stands alone. So again, by monopoly, we mean the kind of company that's so good at what it does that no other firm can offer a close substitute. The lesson for entrepreneurs is clear. If you want to create and capture lasting value, do not
Thank you, guys.
Undifferentiated commodity business. And so he references this is exactly what they did at PayPal. He said in 2001, my coworkers at PayPal and I would often get lunch on Castro Street in Mountain View. We had our pick of restaurants, starting with the obvious categories. He's going to list a bunch of categories, but even if there's a dozen options to choose from. So he says, in contrast to the competitive look.
So I'll give you guys a little bit of background on what we're doing right now. So, and this is the overall strategy. Maybe I shouldn't be sharing this, but it's been brought up to me a couple times that people say, Will, you're sharing too much. You're airing out your dirty laundry, blah, 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 blah. Here's my view on this. My view is that at the end of the day, if you're showing up every single day, you're doing your best, you're trying to do the right thing, and you're just showing what that journey's like, then I don't think that that's gonna, well, let me put it this way. Yes, it's definitely possible that there can be negatives from sharing everything that I'm sharing, but I think that the net positive is going to be better than if I just don't share it. So I'm completely open to sharing everything. So what am I doing on my phone right now? I think at the end of the day, if we want to have a chance to go big and compete, I'm talking about my worker, then we need to find the right partners to come on this journey. And those right partners are the right people, the right investors, really the right initial customers as well. And so the part that I'm focused on is building out these target lists. So these target lists are like the final, like if you had a magic wand and you had your dream investors or your dream customers, what would those people look like? And I'm doing research with AI. You can go to ChatGPT, and on ChatGPT, you can do deep research. So that's what I'm doing. I'm doing deep research with ChatGPT. And what I initially did, I did some of this ahead of this stream, but I was pulling together and giving a lot of background information on my worker. I was talking about where we're at with the company, how much we've raised, what the traction has been, what have been the challenges, like try and give as honest of an assessment as to where the company stands today. And so I was doing this, trying to give an honest assessment where it was at, to give context. Context is important. So then the AI knew or knows where we're at. And then I started saying, look, we're going to be running email campaigns with my worker, but we want to be top of mind with these guys. And by top of mind, I mean, I want them seeing us on social media. I want them seeing us posting on X. I want them seeing us posting on LinkedIn. I want to like be engaging with their content whenever they post. Like really just make us really just make us top of mind so we can get our foot in the door, get the meeting, close the deal. And so we're doing all this stuff. We're doing the social media, but the idea now is we need to, in our own document, get organized, right? We need to follow all these people. We got to turn on notifications, and then we got to engage with them when they go online. So that's the game plan. That's what I'm doing right now, is trying to build out the final target list of the investors, and outside of just those investors, figuring out, what their profiles are. So are they on X? Are they on LinkedIn? And then turning on those notifications. So that's what I'm working on now. That's what I'm going to be doing with my assistant when she gets in. I'm going to be giving her this list. And if I finish this up in time, I'm also going to be coming up with some more posts for us to save in our post bank for social media on LinkedIn and X. So this all ties into the strategy, because going back to the social media thing, you can't spam someone with like 3 emails a day to get to remind them that you exist. Ideally, we're going to be reaching out to people where, yes, it benefits us, but it benefits them. We're able to help them in a big way. So there's a deal to be done. But if we're constantly out there on social media and they're seeing our face, X, Y, and Z, then we're going to be top of mind and they're going to move our deals along. So, and we're not going to have to be like, hey, blah, 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 doing all this stuff to get on their radar, because they're just going to see us out there. So that's the strategy. That's what I'm working on. Back to Peter Thiel.
Local restaurant market. PayPal was at the time the only email-based payments company in the world. We employed fewer people than all the restaurants did, but our business was much more valuable than all of those restaurants combined. And this is just an absolutely fantastic line that ties back to the very beginning of the book, on the very first page of the book. The note is this book exists to help you think through how to make new things. Why is that important? Every business is successful exactly to the extent that it does something others cannot. All happy companies are different. Each one earns a monopoly by solving a unique problem. All failed companies are the same. They failed to escape competition. And he does a great job of summarizing why aiming for monopoly and avoiding competition is a path to create wealth. A creative monopoly means new products that benefit everybody and sustainable profits for the creator. Competition means no profit for anybody, referencing what he just wrote about over several paragraphs with the American airline industry. So competition means no profits for anybody, no meaningful differentiation, and a struggle for survival. Then I want to skip ahead to his thoughts on the importance of durability. This is Charlie Munger's obviously a personal hero of mine. I think it was his son in Poor Charlie's Almanac. In the book Poor Charlie's Almanac says that durability has always been a first-rate virtue in his dad's eyes. I mean, Charlie Munger's eyes, he thought durability was always a first-rate virtue. For Peter Thiel, Peter's like, well, listen, technology companies usually follow the opposite trajectory. So he was talking about the fact that like a popular nightclub or a popular restaurant in your city, successful ones are going to collect very healthy profits today. But usually their cash flows dwindle over the next few years or a decade from now because customers tend to move on to like the newer, trendier alternative. And so Peter's point is, well, technology companies follow the opposite trajectory, that all the value, most of the value is happening a decade, 2 decades from now. And so that is why he prioritizes durability. He says technology companies follow the opposite trajectory. They often lose money for the first 2 years, or first few years rather. Most of a tech company's value will come at least 10 to 15 years in the future. And so then he continues, the overwhelming importance of future profits is counterintuitive even in Silicon Valley. For a company to be valuable, it must grow and endure. So he actually italicized those words, and endure. It must grow. I think a lot of people have been focused on the grow part and not on the enduring part, right? Everybody that you and I study in this podcast knows exactly what Peter's talking about. All of their businesses lasted for decade after decade after decade. So the company, to capture all the company value, it has to grow and endure. But many entrepreneurs focus only on short-term growth. They have an excuse. Growth is easy to measure, but durability isn't. Those who succumb to measurement mania obsess over weekly active users, monthly revenue targets, and quarterly earnings. However, you can hit those numbers and still overlook deeper, harder to measure problems that threaten the durability of your business. If you focus on near-term growth above all else, you miss the most important question that you should be asking. Will this business still be around a decade from now? And that is a much harder question to answer, because it says numbers alone will not tell you the answer. Instead, you must think critically about the qualitative characteristics of your business. And so then Peter takes us through, like, what are some characteristics to have a durable business you're going to be able to collect profits 10, 15, 20 years from now? What does a company with large cash flows far into the future look like? Every monopoly is unique, but they usually share some combination of the following characteristics. Number 1, proprietary technology. Number 2, network effects. Number 3, economies of scale. And number 4, branding. This is not a list of boxes to check as you build your business. There's no shortcut to monopoly. However, analyzing your business according to these characteristics can help you think about how to make it durable. So I'm just going to pull out a couple of the highlights. He goes into this. If you have the book, or obviously, I think everybody should have this book. Every founder should have this book. You could read it, 2 or 3 days easily. This is in the last mover advantage chapter. So number 1, proprietary technology. Proprietary technology is the most substantive advantage a company can have because it makes your product difficult or impossible to replicate. His example is Google's search algorithms. Number 2, network effects. So he's going to talk about Facebook there, but this is the way to define network effects. Makes a product more useful as more people use it. Number 3, economies of scale. A monopoly business gets stronger as it gets bigger. The fixed cost of creating a product can be spread out over ever greater quantities of sales. Software startups can enjoy especially dramatic economies of scale because the marginal cost of producing another copy of the product is close to zero. This is going to sound real familiar because that idea is in Paul Graham's essays over and over again. I'm sure I've talked about it in most of the last few episodes. He says a core group of talented people can provide something of value to millions of separate clients. And then number 4, branding, which is also, I've heard Peter talk about, he did a bunch of podcast interviews when he was promoting this book a long time ago, and he says this is something that the one area that he understands the least, and that's branding. Creating a strong brand is a powerful way to claim a monopoly. Today's strongest tech brand is Apple. This is very fascinating, right? He's writing these words, 2012 was the class, 2014 the book is published, almost a decade later. Today's strongest tech brand is still Apple. Then he goes into the very beginning of building a monopoly. This is going to be, again, echoing the ideas that were in Paul Graham's essay. In his essays, Paul Graham kept quoting this guy named Paul Bouchette, I think is his name. It's the engineer who created Gmail. And he said that it's better to make a few people really happy than to make a lot of people semi-happy. So Peter says every startup should start with a very small market. Small does not mean non-existent. It is much easier to reach a few thousand people who really need your product than to try to compete for the attention of millions of scattered individuals. The perfect target market for a startup is a small group of particular people concentrated together and served by few or no competitors. That's a fantastic thought. I want to sit here and think about it a little bit more. Let me read it to you again. The perfect target market for a startup is a small group of particular people concentrated together and served by few or no competitors. The exact opposite of trying to build a product and compete for the attention of millions of scattered individuals. Once you create and dominate a niche market, then you should gradually expand into related and slightly broader markets. Amazon shows how this can be done. Jeff Bezos' founding vision was to dominate all of online retail. We know this because, I've done 5, 6 podcasts on Jeff in the archive. And when he was at D.E. Shaw, the code name for Amazon inside that hedge fund was the everything store. He just started with books. So it says, Amazon shows how this can be done. Jeff Bezos' founding vision was to dominate all of online retail. But he very deliberately started with books. So now we know how that paragraph ends. Let me read it from the top. Once you create and dominate a niche market, then you should gradually expand into related and slightly broader markets. Amazon shows how this can be done. Jeff Bezos' founding vision was to dominate all of online retail, but he very deliberately started with books. And then he points out, okay, that sounds like, you can read that paragraph over again, it sounds like, okay, I can do that. His whole point is sequencing markets correctly is underrated, and it takes discipline to expand gradually. The most successful companies make the core progression to first dominate a specific niche and then scale to adjacent markets, a part of their founding narrative. So then we move on to, I would say, Peter's overall worldview that you can have control a lot more than you think and essentially shape the world around you. And then he feels that this belief is completely counter to what is the prevailing cultural belief. And so he has an entire chapter called You Are Not a Lottery Ticket. And part of this is that you're going to be going up against, I don't even know if you go up against, like there's a lot of people that just don't believe you have any control over the future. And so Peter makes the case that this is a relatively new belief. He says every company starts in unique circumstances and every company starts only once. Statistics don't work when the sample size is one. From the Renaissance and the Enlightenment to the mid-20th century, luck was something to be mastered, dominated, and controlled. So he's clearly telling you how he views things, right? So it says Ralph Waldo Emerson captured this ethos when he wrote, "Shallow men believe in luck, believe in circumstances. Strong men believe in cause and effect." And I love what Peter does here. He's challenging us, like, well, do you believe this or not? And if you do believe that everything is just random and luck, then put down the book because you're just wasting your time. So he says in 1912, after he became the first explorer to reach the South Pole, Amundsen, I forgot how to pronounce his name, wrote, "Victory awaits him who has everything in order. Luck, people call it." So again, the quote there is, "Victory awaits him who has everything in order. Luck, people call it." No one pretended that misfortune didn't exist. But prior generations believed in making their own luck by working hard. If you believe your life is mainly a matter of chance, why read this book? Learning about startups is worthless if you're just reading stories about people who won the lottery. I'm going to pause right there. It's at this point, I had two quotes pop into my mind. One I found in this book called Explore, Create My Life in Pursuit of New Frontiers, Hidden Worlds, and Creative Spark. It's written by Richard Garriott. I covered it back on episode 257, and I love what he says here. He goes, "My heroes are people who took epic journeys into the unknown, often at substantial personal risk. I am simply following the path that they carved into history." And then the second one is a quote that I've told you over and over again. It's one of the best things I've ever heard. It comes from Mark Andreessen's blog archive, episode 50, if you haven't listened to it. "The world is a very malleable place. If you know what you want and you go for it with maximum energy and drive and passion, the world will often reconfigure itself around you much more quickly and easily than you would think." So let's go back to Amundsen's quote, "Victory awaits him who has everything in order." And this is why it's so important to check, like to take minutes, like what do I actually believe? If you treat the future as something definitive, it makes sense to understand it in advance and to work to shape it. But if you expect an indefinite future ruled by randomness, you'll give up trying to master it. And then something Peter does great is he'll set up the idea. First, he'll compare like how this is how most people think. Then he'll set up he gives you a hint that this is the way I think. Then he tells why is that important. Why is it important to have a definitive outlook on the future? And he says a definitive view, and he's going to tell us. And this is important to entrepreneurs, and something you and I have seen over and over again in the history of entrepreneurship that is very different from what most people's advice is. They tell you that they kind of worship at the altar of diversification. And you'll find many of history's greatest entrepreneurs, Warren Buffett, Charlie Munger, Edwin Land, Steve Jobs, over and over again, they reject diversification, they go all in. And the way to think about it is they're striving to be great at something substantive. And this is how Peter thinks about it. A definitive view favors firm convictions. Instead of pursuing many-sided mediocrity and calling it well-roundedness, he is not playing. Instead of pursuing many-sided mediocrity and calling it well-roundedness, a definitive person determines the one best thing to do and then does it. Instead of working tirelessly to make herself indistinguishable, she strives to be great at something substantive, to be a monopoly of one. A definitive person determines the one best thing to do and then does it. They do not pursue many-sided mediocrity. And then I just referenced Steve Jobs. That was no accident because Peter starts to end this chapter on how Steve rejected this idea that you're a lottery ticket and that you can actually pursue a big goal over multiple decades. So he says the most important lesson to learn from Steve Jobs has nothing to do with aesthetics. The greatest thing Jobs designed was his business. Apple imagined and executed definitive multi-year plans to create new products and distribute them effectively. Forget minimum viable products. Ever since he started Apple in 1976, Jobs saw that you could change the world through careful planning, not by listening to focus groups or by copying other people's successes. This is such a great line here. Long-term planning is often undervalued by our indefinite short-term world. And then he tells a great story to round out this chapter. He's the first outside money into Facebook, and he was on their board when they got that $1 billion offer in 2006. And he tells the story of why Mark Zuckerberg completely dismissed even the thought of taking the money at that point. The power of planning explains the difficulty of valuing private companies. When a big company makes an offer to acquire a successful startup, it almost always offers too much or too little. And he says you should only sell if you don't have a concrete vision for the company. Founders only sell when they have no more concrete visions for the company. Definitive founders with robust plans don't sell, which means the offer wasn't high enough. Well, that's interesting that he says that, which means the offer wasn't high enough. But is there always a price? Like for Steve Jobs, there's no price, right? There's no, I think if you read a bunch about him and study him, it's like you could offer him $10 trillion for Apple. He's not interested. He doesn't care. I mean, I'm not saying he doesn't care about the money, but he's not doing it for the money. I don't think there's any price that he would have, if you say, what's the price that you don't get to work on this anymore? I don't think there's actually any price there. So, but he says, when Yahoo offered to buy Facebook for $1 billion in July 2006, I thought we should at least consider it. But Mark Zuckerberg walked into the board meeting and announced, okay, guys, this is just a formality. It shouldn't take more than 10 minutes. We're obviously not going to sell here. Mark saw where he could take the company, and Yahoo didn't. A business with a good, definitive plan will always be underrated in a world where people see the future as random. See what he did there? This is nearly 20 pages later at the beginning, from the beginning of the chapter, and he just ties all these ideas together. And the great thing about this book, too, is you don't have to necessarily read it in sequential order. You can just pick up and read a chapter at a time, which I actually think is a better use. After you read it once all the way through, just keep it out and kind of use it as a reference. Because I think just picking up, basically what I'm talking about myself here is like, hey, I should really like to get this idea in my brain, reread this chapter from time to time. That you are not a lottery ticket chapter. And then I just got to read one more thing from this chapter. It's the last paragraph. It's absolutely fantastic. A startup is the largest endeavor for which you can have definitive mastery.
Guys, we've been cranking over here. We've been cranking. All right, so quick update. So our assistant's coming in soon, and we've been cranking out tweets. Okay, we've been cranking out. Follow us on X. Okay, Will_Saz. We're putting out some awesome bangers on X. The way that we do it is we just save everything into like a Google sheet, and then we transfer all of that over to the docs, and then from there, or into our drafts, and then I can just post it throughout the day. So that's what we're gonna do. I'm gonna leave this playing, and I'm gonna put myself on mute. I'll be right back. One second.
Mastery. You can have agency not just over your own life, but over a small and important part of the world. It begins by rejecting the unjust tyranny of chance. You are not a lottery ticket. Then he has an entire chapter on the fact that we don't live in a normal world. We live under a power law, or why do just a handful of businesses generate all the profits? And the way you think about this is that small minorities often achieve disproportionate results. So he says this extraordinary
doesn't just apply to business, in which a small few radically outstrip all rivals surrounds us everywhere in the natural and social world. The most destructive earthquakes are many times more powerful than all other smaller earthquakes combined. The biggest cities dwarf all mere towns put together, and monopoly businesses capture more value than millions of undifferentiated competitors. The power law, so named because exponential equations describe severely unequal distributions, is the law of the universe. It defines our surroundings so completely that we don't even see it. This chapter shows how the power law becomes visible when you follow the money. We do not live in a normal world. We live under a power law. And so then he talks about his business, which is being a venture capitalist. He's like, the whole point is like power laws dominate venture capital, and even most venture capitalists don't understand that. And then he goes into the power laws dominate not only the entire industry, but individual funds as well. The big question is when this takeoff will happen. For most funds, the answer is never. Most startups fail, and most venture funds fail with them. Every VC knows that his task is to find the companies that will succeed. However, even seasoned investors understand this phenomenon only superficially. They know companies are different, but they underestimate the degree of difference. And he goes back into this theme about this anti-diversification. Venture returns do not follow a normal distribution. They follow a power law. A small handful of companies radically outperform all others. If you focus on diversification instead of single-minded pursuit of the very few companies that can become overwhelmingly valuable, you'll miss those rare companies in the first place. And then you just got a great sentence about this. Power law distributions are so big that they hide in plain sight. And then he goes into why is understanding the power law important for founders. This is going to be very similar to, again, reference, I want to tie this all together to Paul Graham's essays as well, where he talks about, says, listen, Larry Page and Sergey Brin, the founders of Google, are wealthy because they were the first investors in Google. They didn't invest with their money, they invested with their time and their energy and their skill set. The power law is not just important to investors. It's important to everybody because everybody is an investor. An entrepreneur makes a major investment just by spending her time working on a startup. Therefore, every entrepreneur must think about whether her company is going to succeed and become valuable. Every individual is unavoidably an investor too. When you choose a career, you act on your belief that the kind of work that you do will be valuable decades from now. See what he did there? He tied this idea from a previous chapter. That, again, these all tie together, right? A couple chapters ago, one of my favorite sentences in the book about the importance of durability, making sure that you're building a durable company, right? If you focus on near-term growth above all else, now I'm quoting from a previous chapter, you miss the most important question you should be asking. Will this business still be around a decade from now? Back to this chapter. When you choose a career, you act on your belief that the kind of work you do will be valuable decades from now. That is so important. Every decision I try to make, it's like, I just want to make sure I don't mess up a good thing. Because I know most people making podcasts are not going to be around a decade from now. I don't have to be the best. I don't have to be the smartest. I don't have to be the most talented. I just have to outlast you. And there's no fucking way I'm quitting. And so I just love that idea. Let's see who's going to be around a decade from now. When you choose a career, you act on your belief that the kind of work you do will be valuable decades from now. An entrepreneur cannot diversify herself. You should focus relentlessly on something you're good at doing. I love that he says that. But before that, you must think hard about whether it'll be valuable in the future. And then he ties us back into the fact that we live under a power law, so you must understand it if you're going to succeed. If you do start your own company, you must remember the power law to operate it well. The most important things are singular. One market will probably be better than all others. One distribution strategy usually dominates all others too. You cannot trust a world, which is he's describing, again, this is what he believes. Now he's going to compare and contrast it with what most humans on the planet believe, right? It's completely different. You cannot trust a world that denies the power law to accurately frame your decisions for you. So what's most important is rarely obvious. It might even be a secret. And so then he goes right into the next chapter, which is titled Secrets. Secrets give you an edge. That is his main theme in this chapter. It's something, it's really important. The idea of edge, anytime I see the word edge now, I automatically think Ed Thorpe, who I'm trying to, is my personal blueprint. Covered him on episode 222 if you don't know what I'm talking about. But he's writing that book. I think he's probably 80. He's definitely in his 80s when he's writing his, maybe 80, when he's writing his autobiography. And he talks about, he's like, listen, I've had 50-year experience as a money manager. He's like, listen, I believe that the surest way to get rich is to only play games or make investments where I have an edge. Secrets give you an edge. Let's go to Peter. Every one of today's most famous and familiar ideas was once unknown and unsuspected. A conventional truth can be important. It's essential to learn elementary mathematics after all, but it does not give you an edge. It is not a secret. And so using contrarian thinking is how you uncover secrets. Contrarian thinking does not make any sense, though, unless the world still has secrets left to give up. Recall the business version of our contrarian question. What valuable company is nobody building? Every correct answer is necessarily a secret. Something important and unknown. Something hard to do, but doable. If there are many secrets left in the world, there are probably many world-changing companies yet to be started. So if you think about what he's saying there in that paragraph, how do you spot opportunity? You ask yourself, what valuable company is nobody building? And there's just a few sentences later on in the chapter that made me think of when Paul Graham writes in the essay, Schlepp Blindness, talks about problems that are so difficult that people, they're hiding in plain sight. He uses Stripe as an example. It's like how many tons of developers knew it was a pain in the ass to accept a credit card online, and yet they'd build like recipe aggregator websites or whatever, because it's just so tough. It's like hiding. I just can't even think that it's even possible. And so Peter says, if you think something hard is impossible, you'll never even start trying to achieve it. Same idea. One is in the 0 to 1 book. The other idea, same idea, is written in a different context in Paul Graham's essay. I love how this shit fits together. That always gets me excited. If you think something hard is impossible, you never even start to try to achieve it. Belief in secrets is an effective truth. The actual truth is that there are many more secrets left to find, but they only yield to relentless searchers. The same is true of business. Great companies can be built on open but unsuspected secrets about how the world works. And then this gets into the fact that Peter he believes in the ability to conspire, to have a conspiracy, to have a secret, to recruit co-conspirators, to not tell the outside world what you're doing, and to effectively plan and change the world around you. That not only for business, which is what this book is about, but if you haven't read Ryan Holiday's fantastic book, Conspiracy, goes into essentially Peter seeking revenge on somebody. The actual storytelling, whether you think it was a good idea or not, that's not really what I'm debating here. I think the storytelling and the writing in that book is absolutely fantastic. In fact, I have the hardcover, the Kindle, and the Audible version of that book. I liked it so much. So this is essentially, I'm like leading into the end of this chapter, which I thought was interesting, is the fact that when you do find a secret, Peter's going to tell you, shut up about it. Bad boys move in silence. If you find a secret, you face a choice. Do you tell anyone, or do you keep it to yourself? It depends on the secret. Some are more dangerous than others. Unless you have perfectly conventional beliefs, it's rarely a good idea to tell everybody everything that you know. So who do you tell? Whoever you need to and no more. In practice, there's always a golden mean between telling nobody and telling everybody, and that is a company. The best entrepreneurs know this. Every great business is built around a secret that is hidden from the outside. A great company is a conspiracy to change the world. When you share your secret, the recipient becomes a fellow conspirator. Okay, so then he gets into the importance of laying the foundation for your company, that if you mess up the foundation, you cannot fix it. This is going to, again, tie into what the fact that Paul Graham writes in his essays, that on the Y Combinator application, they ask more about the relationship between co-founders than anything else. And this is why every great company is unique. But there are a few things that every business must get right at the beginning. I stress this so often that friends have nicknamed this Thiel's Law, which is a startup messed up at its foundation cannot be fixed. Bad decisions made early on, if you choose the wrong partners or hire the wrong people, for example, are very hard to correct after they are made. It may take a crisis on the order of bankruptcy before anybody will even try to correct them. As a founder, your first job is to get the first things right, because you cannot build a great company on a flawed foundation. And the very first decision that's most important is who you're picking as a co-founder. When you start something, your first and most crucial decision is whom to start it with. Choosing a co-founder is like getting married, and founder conflict is just as ugly as divorce. If the founders develop irreconcilable differences, the company becomes the victim. When I consider investing in a startup, this is going to sound a lot like Paul Graham and Y Combinator, I study the founding teams. Technical abilities and complementary skill sets matter, but how well the founders know each other and how well they work together matter just as much. Founders should share a prehistory before they start a company together. Then a few pages later, he goes back into why this is so important to make sure that you're picking the right people that are around you. Since time is your most valuable asset, it is odd to spend it working with people who you don't envision any long-term future together. If you cannot count durable relationships among the fruits of your time at work, you haven't invested your time well. And so the next sentence he says is exactly what Steve Jobs told us back in 1987. He was interviewed for that book, In the Company of Giants. And they're like, hey, they're at like Stanford MBA students, if I remember correctly. And they're like, yeah, but startup founders don't have a lot of time to recruit people. And Steve's like, no, I disagree completely. Recruiting is the founder's most important job. And he's like, the success depends on the first 10 people that you recruit into your company. And Peter Thiel says, recruiting is a core competency. It should never be outsourced. And he says this is extremely difficult because talented people do not need to work for you. They have plenty of options. So he gives us a couple ideas here. General and undifferentiated pitches do not say anything about why a recruit should join your company instead of many others. The only good answers are specific to your company, so you will not find them in this book. But he does give advice where it's like you need to pick somebody that's obsessed with working for your specific company because they believe in the mission. Do not fight the perk war, meaning the kind of people that are swayed by what he says, like free laundry pickup or pet daycare would be a bad addition to your team if you're a startup. Just cover the basics like health insurance and then promise what no other company can. The opportunity to do irreplaceable work on a unique problem alongside great people. Ideally, you're shooting for a tribe of like-minded people fiercely devoted to the company's mission. And then Peter talks about one of the best ideas I've actually ever heard from him. And this is the idea he used when he was CEO of PayPal. And he's
It's like he would only assign one thing. So it's under the subtitle, do one thing. There's actually a video
All right, guys.
where Keith Roy is a founder investor, but at the time was working at PayPal under Peter, gives some more context to why this is valuable. I'll read from that transcript in 1 second. Let me lay out the idea.
All right, you guys can hear me?
The best thing I did as a manager at PayPal was to make every person in the company responsible for doing
All right, I think
just
you can.
one thing. Every employee's one thing was unique, and everyone knew I would evaluate him only on that one thing. In fact, if you tried to go up to Peter and talk to him about something other than the one thing that he assigned to you, he would not have the conversation with you. So it says that everyone knew I would evaluate him only on that one thing. I had started doing this just to simplify the task of managing people, but then I noticed a deeper result. Defining roles reduce conflict. Most fights inside a company happen when colleagues compete for the same responsibilities. And so there's a video I'll link below. It's called Insist on Focus. It's like 3 minutes long, and I'm just going to read from the transcript real quick, which is Keith Raboy describing why Peter Thiel to do one thing and only talking to them about one thing was actually such a successful strategy. He says the reason this was such a successful.
All right, guys. So I am going to hop on this call here. I'm going to mute myself while I'm going through this stuff with her just to kick it off. So I'm not going to interrupt the video. But it looks like we've got about 7 minutes left. So we're coming down to the end. I'll let it continue to play. And then at the end, I have a couple of notes on the video, a couple of thoughts. We'll discuss that after I get her kicked off. And then we'll end the live there.
The strategy is that most people, perhaps all people, tend to substitute from A+ problems that are very difficult to solve B+ problems, which you know a solution to, or you at least are on a path to solve. He says, let's say you have a checklist every morning. Imagine waking up. A lot of people write checklists of things they need to accomplish. Most people have an A+ problem, but they don't know the solution, so they procrastinate on that solution. And then they go down the checklist to a second or third initiative. And then they'll go try to solve those problems. That's the problem. Solve the second, third, or fourth thing. Never solve the first. And so only work on one thing. And everybody has to work on A+ problems. And every member of the organization wants to solve them. This is impossible. Most explicitly about this is number 244 on In-N-Out Burger. The best startups at Trader Joe's is also a version of this idea. Peter's talking about the best startups might be considered slightly less extreme kinds of cults. The biggest difference is that cults tend to be fanatically wrong about something important. People at a successful startup are fanatically right about something those outside have missed. And then he has an entire chapter dedicated on the importance of sales and distribution. The beginning of the chapter we'll get to in a second, but one of the most important sentences in the entire book is when he writes, superior sales and distribution by itself can create a monopoly, even with no product differentiation. The converse is not true. And then this is another example of something he brings up a few times where there's just a lot of things that are hidden in plain sight. Even though sales is everywhere, most people underrate its importance.
It may not matter in fictional worlds, but it matters in ours. We underestimate the importance of distribution, and he's going to define that as a term, a catch-all term for everything that it takes to sell a product. And so he says customers will not come just because you build it. You have to make that happen, and it's harder than it looks. In Silicon Valley, nerds are skeptical of advertising, marketing, and sales because they seem superficial and irrational. But advertising matters because it works. It works on nerds and it works on you. You may think that you're an exception, that your preferences are authentic, and advertising only works on other people. It's easy to resist the most obvious sales pitches, so we entertain a false confidence in our own independence of mind. But advertising doesn't exist to make you buy a product right away. It exists to embed subtle impressions that will drive sales later. Anyone who cannot acknowledge its likely effect on himself is doubly deceived. And he goes into this idea that the best sales is hidden, that the grandmasters of sales, and he references a few in the book, but we're going to use an example from 1876 in the writing of Mark Twain. It's just a really interesting thought about the best sales is actually hidden. There are sales grandmasters. If you don't know any grandmasters, it's not because you haven't encountered them, but rather because their art is hidden in plain sight. Tom Sawyer managed to persuade his neighborhood friends to whitewash the fence for him. This was a masterful move. But convincing them to actually pay him for the privilege of doing his chores was the move of a grandmaster, and his friends were none the wiser. Not much has changed since Twain wrote in 1876. The most fundamental reason that even business people underestimate the importance of sales is the systematic effort to hide it at every level of every field in a world that is secretly driven by it. The engineer's grail is a product great enough to, quote, sell itself. But anyone who would actually say this about a real product must be lying. Either he's delusional, which means he's lying to himself, or he's selling something and thereby contradicting himself. It's better to think, this is so fantastic. It is better to think of distribution as something essential to the design of your product. If you invented something new, but you hadn't invented an effective way to sell it, you have a bad business no matter how good the product. This is something I bring up over and over again. There's this famous speech where Steve Jobs, it's on Steve Jobs' plan to return to Apple, or plan to turn around Apple. He gives it right, it's like 1987, maybe 1998. It's a few weeks after he had returned to Apple. But what's so fascinating about that talk, which it's a really great talk to watch, is when you hear people describe it, they tend to focus on Steve's comments about going back and building great products, the fact that Apple's products suck at the time. He says, they have no sex in them is one line that's from the talk that's rather famous. But what they miss is the fact that he said, we're going to get back to great products, great marketing, and great distribution. It wouldn't have worked if it was just we're going to get back to great products. That's not what he said. And it's exactly what Peter's saying here. It's you need to think of distribution as something essential to the design of your product. If you've invented something new but haven't invented an effective way to sell it, you have a bad business no matter how good the product. So then he goes into what I feel is the most important sentence in this chapter that I've already read to you. Superior sales and distribution by itself can create a monopoly, even with no product differentiation. The converse is not true. No matter how strong your product, even if it easily fits into already established habits and anyone who tries it likes it immediately, you must still support it with a strong distribution plan. And then Peter says that distribution, like many things in life, will also follow under the power law. This is I'm going to read the entire paragraph. It's titled The Power Law of Distribution. One of these methods is likely to be far more powerful than every other for any given business. Distribution follows a power law of its own. This is counterintuitive for most entrepreneurs who assume that more is more. But the kitchen sink approach, employ a few salespeople, place some magazine ads, and try to add some kind of viral functionality to the product as an afterthought, does not work. Most businesses get zero distribution channels to work. Poor sales rather than bad product is the most common cause of failure. If you can get just one distribution channel to work, you have a great business. And then he ends with a main theme in the history of entrepreneurship. Everybody sells. Everything requires to be sold. Everybody sells. Everybody has a product to sell, no matter whether you're an employee, a founder, or an investor. And then I'll end on this parting advice. Our task today is to find singular ways to create new things that will make the future not just different, but better. The essential first step is to think for yourself. And that is where I'll leave it. For the full story, highly recommend buying the book. If you buy the book using the link that's in the show notes of your podcast player, you'll be supporting the podcast at the same time. If you want to use the same app that I use to store all the highlights and notes for the books that I read, I use this app called Readwise, and they will give you 60 days free to try it to see if you like it as much as I do. All you have to do is go to readwise.io/founders, and that link will also be in the show notes. That is 278 books down, 1,000 to go, and I'll talk to you again soon.
The other day I saw an article of a gym that has a sushi bar on the gym floor. That is what I like to call heaven, but also a level 5.
I guess real quick, do you have any questions on things before I sign off on the stream? Yeah, let's do that. Because I think I might give like a quick breakdown to the stream about the video that I just played on the stream. Yeah. All right, awesome. I'll just mute myself here while I do that. All righty, guys. Guys. What a video. Feel free to drop your thoughts in. I'll give my feedback, thoughts on everything. But I do have some notes here. So we will dive into those real quick for you guys. Okay, so here we go. And this is my first time doing this whole setup on the road. We will have it a little bit more dialed in the future, but here we go. So key insights. Here we go. What were some of the key insights that you guys thought there? So one of the big things about Peter Thiel is that he's always trying to think of, okay, what are the contrarian beliefs that are true? So what is the thing that the majority of other people are wrong about? And if you can identify what those things that the majority of people are incorrect about, then it gives you an upper hand, especially if it's related to your startup. He talked about that. He talked about how do you build a monopoly? If you have a monopolistic business, which many times as a startup, you have no business, but if you can start to implement some of those things that make a monopoly a great defensible business, and you aim at that trajectory, then you're inherently going to build a foundation that is going to allow you to build a sustainable and very big business. So what are some of the insights that he went through here? I have some of these written down. Thank God I watched this video yesterday on the flight back for Thanksgiving. So he talks about durability over speed. He talked about how a lot of people, they're focused on these speed, short-term metrics, user metrics. He takes more of a long-term approach. He says, okay, what are the fundamentals of your business, and do those fundamentals last for the next 10 years? He talks about monopoly versus competition, which we just covered. You want businesses that can move towards the advantages that you see within monopolies. He talks about power laws. He talks about founders, almost in a weird way when you're building a startup, building almost like a cult, like a very mission-driven group of people who are joining you early on, and you're not necessarily giving them a luxury lifestyle or anything. You're covering the costs and what they need, but then you're getting them to basically come with you on this crazy journey in building your startup. So I think that those were one other thing I almost forgot. He talked about distribution. And so lots of product people actually disagree with what Mr. Thiel is saying here. I'm going to put this camera on. So he talks about product versus distribution. So a lot of people, especially engineers on the product side, sorry, I'm trying to get this camera to work. All right, there we go. See, this is so cool. Now it will follow me. A lot of people will talk about product versus distribution. And people who are traditional engineers will think, okay, well, if we got a great product, people will buy it. It'll be able to sell itself. But Peter Thiel talks about how distribution is fundamentally super important for a startup. He said you can have a great product and distribution, and that's great. You could have great distribution and no product, and that would actually still work. But if you have a product and no distribution, then it won't work. So fundamentally, he's talking about how distribution is, in a way, even more important than having a great product. And so finding good distribution is very important for startups. These are all fundamentals that are taken from the Founders Podcast and covering his book, 0 to 1. This is almost like the holy grail of startup reading material. You talk to most VCs, most mentors in the startup game, they'll tell you how 0 to 1 is a must read. So you guys got a lot of the big key lessons from the book in this video. We're going to be doing a lot more of these types of it's actually so funny. I can't even take this seriously because I'm looking at the screen right now. There's this guy, Will Tennyson, who's a fitness influencer. Very entertaining videos, but it auto-played this next. And so he's on the screen right now. But yeah, in our future videos, we're going to be doing this type of an approach on some of the streams, that being, hey, there are these great videos, things covering Peter Thiel, Elon Musk, Steve Jobs, Don Valentine, just different people who've been very big in the startup ecosystem, built some very big companies. We want to learn about their thought process. How do these people think? What makes them different? What are the common trends that we're seeing? So these are all areas that we're going to dive into on future streams. I'm going to get to work, put some of these principles that we just learned from Peter into practice here with My Worker AI and SAS Mining. As you guys know, we're building these companies in public, so you guys are going to see the raw behind the scenes. And with SAS Mining, we're making it easy for you to start mining Bitcoin. Many people don't know that you can actually acquire Bitcoin through the Bitcoin mining process, and you don't need a PhD in power or anything. We built that with SAS Mining. And then with My Worker, building sales software. So trying to help companies implement AI into their sales processes to scale their businesses. So with that, we're going to sign off. Thank you guys so much for staying tuned. And big congrats to us for getting this stream done in this way. This was a new experiment, and I think we did a good job. Bumpy start at first, but we got there.